next topic we will talk about security analysis or valuation. So this topic is very important if you want to become investor, invest in security. So what is security? Legal contract representing the right to receive future benefits under a stated set of conditions. So bond can be, or bond is security. Stocks is security, right? Preferred stock also security. So we need to value the security or value of bond. Why do we need to find the value of the security? Because you want to buy at the right price, right? Because the security bond can be traded in the bond market, and you want to know how much should you pay for bond, okay, compared to the market price. So you need to find the value. We have three different type of value. Number one, book value. Book value or accounting value, you can get it from the financial statements. Market value, you can obtain by looking at the bond market, or stock market, whatever market that you're looking for. You can check online. You see, you go to bond exchange, you go to a website of stock exchange, you will see the market price that they're being traded right now. And the third value, this is the value that we're looking for. We call intrinsic value or the fair value. Investor need to calculate intrinsic value in order to compare with market value. Okay, how do we calculate intrinsic value? Intrinsic value is the summation of or discounted expected cash flow. Once you need discount it, you need to discount by your required rate of return or interest rate that you want, right? Remember interest rate, three components: real risk-free, inflation, and risk premium. So once you get intrinsic value, you must compare with market value. If your intrinsic value is higher than market value, what does it mean? Let's say market value is $10, intrinsic value $20. It means you believe the price should be $20. The market price right now $10 is too low, and if your calculation is correct, the market price should drive up to your intrinsic value, so that you should buy, right? You should buy this security. So can the intrinsic value of the asset differ from market value? Of course, right? Of course. So here is how you get intrinsic value: the summation of discounted expected cash flow. C means the cash flow, right, to be received at time T. K is your required rate of return. It depends on your security. If you are a bond investor, K need to be your required rate of return for bond. If you are a stock investor, K will be the required rate of return for common stocks. They are not the same. Depends on the riskiness of the security. So we will be intrinsic value. So once you want to find intrinsic value of bond, what do you need to do? First step, you need to find C. C or cash flow. So what do you expect from bond investing? You need to know what do you receive. You can predict what to receive the coupon, right? The coupon. So the coupon payment will be equals to par value multiplied by coupon rate. Okay. For example, the annual interest for bond with coupon interest rate 7% and par value of $1,000. So the coupon payment will be $70, right? $70. Step 2, once you have your forecasted or expected coupon, step 2, you need to find discount rate, okay, or your required rate of return from bond, okay, your required rate of return. And again, required rate of return or interest rate equals to three components. The first one, real risk-free rate. Second one, inflation rate. And the third one, risk premium. So risk-free rate, real risk-free rate, and inflation we call what? We call nominal risk-free. And you can obtain by treasury bond yield. treasury bond yield is supposed to be from treasury bond, okay, not credit spread. And the risk premium, it depends on the credit spread, not treasury bond, okay. It's not what you see right now. So nominal risk-free rate depends on treasury bond, and risk premium depends on the credit spread, okay. So how do you find the interest rate? For example, you have to find the nominal risk-free rate. Nominal risk-free rate you can obtain from the government bond yield, okay. So you might look at 30 years U.S. Treasury bond, plus what? Risk premium. Risk premium, you can go and look at the table, right? The table right here represent the risk premium. The number that you see from the table is the unit is basis point, okay. 275 means 275 basis point, or how many percent? 100 basis point equal to 1%. So 275 basis point equal to 2.75%. So these numbers are called the basis point or the spread. You need to add this number with you see the last low, okay, last low U.S. Treasury yield. This is your nominal risk-free rate, okay. For example, if you are about to find interest rate for 30 years and 30-year corporate bond with the rating BB plus, how do you know? You want to find 30 years, you go to this table, okay. You look at the column 30 years, okay, and also look at the low BB plus. You see the number 275, right? 275, how many percent? 2.75%. This is what? The spread, okay, or the risk premium. Risk premium over what? You see the last row, you see U.S. Treasury yield at the same 30 years maturity. The nominal risk free is 4.56%. So you add 2.75% with 4.56%, you get discount rate or your required rate of return for this bond 7.31%. And step 3, once you get what? You get coupon, you get rate of return, you can find intrinsic value, okay, by make the summation of discount expected cash flow, like this equation that I explained to you already. So you need to find the coupon payment, right, to discount, and then at maturity you need to also discount principal or par by KB. KB is your required rate of return for bond investment. Or you can use what? The TVOM table, it will be the same, right? So intrinsic value will be equals to PMT. PMT is coupon, right? PVIFA given KB and N plus par, right? PVIF given KB and N. Once you have a value or intrinsic value, you compare with the market value. If the market value is lower than intrinsic value, is called undervalue bond and we should buy it. On the other hand, if intrinsic value is below market value, is called overvalue bond and we should sell it. Why? Because the bond value from your calculation is the value is lower than the market price. It means what? The market price right now is too high, right? And if your calculation is correct, the price should drop to your intrinsic value. That's why you should sell it. Suppose the firm decides to issue 20 years bond with a par value of 1,000 and annual coupon payment. The return on other corporate bond of similar risk is currently 12%, so interest rate 12%, okay? So we decide to offer 12% coupon interest rate. What should be intrinsic value? So you draw the timeline, right? You get coupon 120. How do you get this 120? 12% coupon, okay? 12% of what? 1,000. So 120 until the end of year 30. You will also get principal 1,000. You make the discount, maybe use financial calculator. You get 1,000, okay? You also can use TVM table, PV equal to PMT, 120 PVFA given 12% N20 plus what? 1000 principal PVAF. Or you can also use the formula, right? From the previous chapter. You get the same answer, which is 1000. Okay, 1000. What does it mean 1000 here? It means if the coupon rate 12%, right, equals to discount rate or your required rate option, the bond will be traded at par value. No need to calculate intrinsic value. It will be equals to par value. Okay. Suppose interest rate fall immediately after we issue the bonds. The required return on bond of similar risk dropped to 10%. So interest rate dropped from 12% to 10%. What happened? What happened? Can we guess without calculation? You receive 12%, 12%, and somewhere else, after interest rate drop, they get lower rate, right? Lower rate than you. So you might want to buy more of your bond, right? And the other will buy your bond as well. So your demand for your bond, the demand of your bond will be higher. So the price will be increased, right? Let's try to find intrinsic value. You can use financial calculator, right? You get intrinsic value 1170.27, which is greater than 1000. Okay. So if the coupon rate is greater than discount rate, the bond will sell for premium. Premium means more than par. Okay, you can also use TVM table or the formula. You get the same answer. If interest rate rise to 14%, what happened? Before you have 12%, now market rate increased to 14%. You don't want to hold your bond anymore, right? Because somewhere else provide you with a higher rate. So you will sell your bond, and the bond value will drop to be 867.54. So if the coupon rate is lower than discount rate, the bond will sell at discount, which is lower than par. You can also use the TVM table to calculate, or use the formula. You will get the same answer.